Have you ever wondered why Warren Buffett doesn't obsess over market forecasts? Or why he often sits on piles of cash, yet doesn't believe in holding cash? Let's break down what the Oracle of Omaha really thinks about investing, diversification, asset allocation, and what he believes is the only true risk in the stock market. Cash is not king. It's a temporary tool. Buffett never holds cash just to have it. He doesn't say, let's keep 10% in cash just in case. If Berkshire Hathaway has excess cash, it's because they couldn't find a great investment at that time, not because they think sitting on cash is a good idea. He's not impressed with asset allocation strategies like 60% stocks, 40% bonds. In Buffett's words, that's nonsense. He believes every dollar should be working, but only if the opportunity is intelligent. Market predictions are useless. Warren and Charlie never base their investment decisions on where they think the market is headed. Why? Because they admit they don't know, and neither does anyone else. Instead, they focus on businesses. If a business is sound, undervalued, and they understand it well, they invest, period. Ignoring a great opportunity just because the market might go down is foolish, Buffett says. Diversification is for the uninformed. The whole idea that you need to own 20 to 30 to 50 stocks for safety? Not in Buffett's world. Buffett once said, diversification is a protection against ignorance. If you know how to value businesses, why settle for your 35th best idea when you could double down on your number one? Buffett himself says he owns one stock in his personal portfolio, Berkshire Hathaway, and sleeps perfectly at night. Risk isn't volatility, it's not knowing what you're doing. Most financial models measure risk by how much a stock price bounces around. It's beta. Buffett calls this twaddle. He gives an example. Farmland prices once dropped from $2,000 to $600 per acre. Did it become more risky? No, it became more attractive. Price volatility doesn't equal real risk. True risk comes from not understanding the business, paying too much, or investing in something that requires constant luck to win. Investing equals buying cash flow in the future. Buffett says there's no such thing as value stocks versus growth stocks. Growth is part of value. You're always trying to buy something today that will give you more cash later. He jokes that when people say it's time to switch from growth to value stocks, they clearly don't understand either. If it's not producing growing, dependable cash, what exactly are you investing in? Don't wait for the perfect crash. Buffett doesn't wait for a market crash to strike. He's not sitting there like a mortician waiting for a flu outbreak. Instead, he's looking for great businesses today. If a crash happens, great, you might get more for less. But don't spend your life waiting. Time is your best asset. The only risk you can eliminate completely, the best investment you'll ever make, yourself. Buffett emphasizes that building your communication skills, your knowledge, and maintaining your body and mind pays more than any stock could. If you were given one car for life, you'd take care of it. Well, your brain and body are that car. Start now. You only get one. Warren Buffett's investing playbook isn't based on predictions, fancy formulas, or Wall Street trends. It's based on thinking clearly, acting with discipline, and always valuing what you understand. And remember, as Buffett says, you're not right because others agree with you. You're right when your facts and reasoning are right.